How you doing, guys? Welcome back to my channel, and this time we're going to talk about what is fractional banking. What is it, why it's so important, and what it has to do with crypto. Well, fractional banking in simple words is a system that the banks use in order to lend out more money because they're only required to have just a fraction of the deposits they have. For example, you go to the bank and you deposit $10,000. The bank keeps in their vaults just $1,000. $9,000 that is left over, they lend out to other people in a form of car loan, home mortgage loan, business loans, private loans. And then the bank makes money by the interest they put on those loans. So that's how fractional banking works. A lot of people say that it helps stimulate the economy, but also a lot of people think that it's some type of fraud because the bank is lending money that they don't have. But you also have to know that this system gives a lot of liquidity to the banks and to the economy too. Now, what are the risks, or what are, besides other people thinking that this could be a fraud or anything like that? Well, the risk is that banks can easily have what is called a run in the bank. A run in the bank is when you have a lot of people thinking that something bad is going to happen to bank X, and they go and take their money from that bank. They try to withdraw the money.
God, okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm.
And a lot of people withdrawing the money at the same time, it causes a run in the bank because the bank doesn't have sufficient funds to the quantity of people that want their money.
What?
This is what happened with Silicon Valley Bank and Signature Bank. That a lot of people they needed their money and the bank didn't have the funds to cover all those deposits. But what this has to do with crypto? Well, the thing is that last year at the peak of the bull market, we had euphoria and we had companies offering crazy APYs, 8, 9, 10 APYs on your crypto. Companies like BlockFi and Celsius. These companies were using this fractional system in order to get those yields and then pay you the rewards, which it was the 8, 9, 10% APYs. They weren't using the blockchain and the code that was just there because of mathematics and the system. They were using all traditional finance systems in order to get a yield. What happened? Well, the thing is that when the bear market came and everything pretty much went downhill, everybody wanted their money and they weren't liquid. Celsius wasn't liquid, BlockFi wasn't liquid, and at some point FTX, but the case of FTX is more complex than that. And that's why I'm making this video, because we're in that turning point when everything in a few months is gonna start looking very green. And a lot of people is gonna have a euphoria. And even when we think that those players are out of the market, there's always somebody who wants to make money on somebody's hope and somebody's belief. So if you see that somebody is offering you 8, 10, 15, 20% on your APY and it's not backed on code, just don't believe it, because they're using fractional banking in crypto. They're lending your money and then they're making more money from yours to give you dimes on the dollar. And the risky part of this is that when the cycle ends in 3-4 years everybody is going to want their money back, and these companies, which hopefully won't exist, but if there are some, these companies will come down with the market. So this is what fractional banking is. This is why it's so important to know the concept. This is why it's so important to know the relationship between fractional banking and crypto. And like always, I'm Blockchain Jose, and if you really like the video, if you got any value whatsoever, don't forget to give it a like and subscribe to the channel in order for me to put out more videos like this. In the meantime, stay safe, be smart with money, and God bless. Peace.